I have the freedom now to spend time focusing on the things that I think are important, and the things that I think are important are helping other people have the freedom to spend times on what they're thinking is important, which I realize is sort of circular, but it really is. It's the thing that matters most to me.
Welcome to the Cash Flow Chronicles. I'm your host, Jonny and the founder of Cattani Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys? And welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny, and I'm joined today by Jeffrey Holst. Jeff is a recovering attorney who hasn't had a bad day in more than a quarter of a century. Jeff pays for his love of adventure and travel through real estate investing. He has climbed to the highest point in Africa, swam with wild dolphins in the Red Sea, dodged sharks while diving at night in Australia, and hiked amongst seals and penguins in Antarctica. Jeff, welcome to the show.
Thanks. Yeah, that Antarctica thing was cool. I just added that to the bio. I'm excited.
That's awesome.
January.
Did you just recently do that?
Yeah, January went to Antarctica. That was amazing. Yeah, it was a lot of fun. And actually I have a new one to add. I just got off of a sailboat. So I actually had to reschedule our original call because I was stuck in the middle of the ocean with no fuel and no wind. So,
oh my gosh. Were you like a sailing team or what was that?
No, I went with a friend of mine, had to reposition his boat because of hurricane season. So we sailed from San Juan, Puerto Rico, down towards Grenada. I didn't actually make it. We ran out of time. I had to fly back. I had some other commitments I had to do. But they'll be there tomorrow actually to Grenada. So
where did you have to get off from?
I jumped off in St. Martin.
Oh, wow.
Yeah. You do a little island hopping in the Caribbean on a 40-foot sailboat. It's a lot of fun.
Oh no, you poor thing.
I was horrible. So terrible. I've got such a terrible life. You guys should definitely not invest in real estate. You might have a life as terrible as mine.
Honestly, I know. Who really wants freedom and passive income, you know?
Yeah, it's overrated.
Well, I'm really excited. We were having an awesome off-camera conversation. We finally decided we needed to record because we were getting into the juicy stuff. So before we do that, just kind of give us real quick backstory. You were obviously an attorney. When did you discover real estate and kind of that power?
Yeah. So, I think I was exposed to real estate really early. I lived in real estate as an infant, like most of us do. But my parents had a few rental properties. So when I was like 14 or 15, I would do like clean outs and stuff for them. And so I always had an interest in it. And I remember watching like late night infomercials when I was that age too, like Carlton Sheets, no money down, real estate investing, and thinking that sounded really cool. But what really appealed to me was whenever they filmed them, they were like by palm trees and pools. And I thought that sounded pretty good. So I wanted to get investing in real estate. And my dad was a lawyer, so I went to law school. I thought, well, if my dad invests in real estate because he's a lawyer, then I should be a lawyer and I can invest in real estate. I sort of subconscious reasoning. I didn't really think it out that clearly, obviously. But it didn't really work out exactly how I planned. I went to law school. I became a bankruptcy attorney. It was fine. I didn't love it. And I kept thinking, okay, when I make a little bit more money, I'll start investing in real estate. This is like 2007, 2008. And I was a bankruptcy attorney. So when the economy collapsed, I got really busy, made a lot of money. And I thought, this is great. Now I might be able to start investing in real estate. The problem, of course, then was you couldn't finance anything. And then I got leukemia and was driven into personal bankruptcy myself, all in a very short period of time. Because I didn't have very good insurance and I had a small law firm with only me making money. So it was just like went from making $5,000 a week to losing $5,000 a week overnight. And then I thought, yeah. So then I thought, hey, it's the worst economy in our lifetime. 2010, 2000, and I have no money and I just went bankrupt. It's the perfect time to start investing in real estate. That's what I did.
Wow. Well, congrats on your recovery and everything. And it sounds like you're living life to the fullest now, which is amazing. And it's awesome that real estate has afforded that because it's truly the power of it. And we were getting kind of deep in the weeds offline about economics, economic landscape that we're seeing. you have some theories about some things. And so it's kind of recap what you're talking about.
Sure.
We kind of defined recession. So kind of define recession for us and why there's this misconception that just because we may be in a recession right now, it doesn't mean that everything is going to tank and the world's coming to an end.
Yeah, I mean, listen, we all went through 2000, or all of us that are old enough to remember 2008 through 2012, let's say. It's terrifying, the idea that real estate's going to collapse. Most markets went down 30-40% in a matter of a year. It was really brutal. That was definitely an economic recession and a real estate recession. What we're talking about now, when people start saying like, well, we're in a contracting economy, it's true. I mean, the classic economic definition of recession is 2 down quarters in a row. First quarter of 2022, definitely a down quarter. We know because the numbers have released. I don't believe they've released second quarter numbers yet, but they're about to release them. I mean, we're sitting in the third quarter, assuming second quarter was also down, which is what most people are predicting. Then we're in a recession, or at least we were a few weeks ago. Technically, if third quarter's up, we're already past that recession, right? Because you're only in the recession once you have 2 down quarters, and you don't know you're out of the recession until they report it later. So, it's like, I'm assuming we're either in a recession right now or just came out of a recession. But that doesn't mean that real estate prices are going to collapse. Fundamentally, real estate is a supply and demand based market cycle. Since the 1850s, the stuff's been tracked to be about an 18-year cycle. Well, it hasn't been 18 years since the last, real estate recession. The market cycle, and I didn't even get to this with you before, but like the market cycle in real estate is really in quadrants. So you start out with expansion, and then you move to hyper supply, and then you move to recession, and then you move to recovery, and then it goes back to expansion. And it just goes in those 4 cycles over and over again. And it's really easy to tell data-wise where you are in the market cycle. Most people think it's really hard, but it's really easy. It's not easy to predict how fast you're going to get to the next section, but it is really easy to tell where you are, because when you think about this, the graph, it's like the horizontal line is long-term historical average occupancy for whatever market it is. So, and it's not like there's one real estate market too, right? There's multifamily real estate in Atlanta, Georgia, and then there's, office buildings in New York. Those are different real estate markets, right? Like they don't have to be correlated, and they're usually not actually. And then there's other, major, developmental trends and stuff that affect things like, work from home versus, whatever. But with residential real estate, it's actually relatively easy to predict. You've got population growth, and you have supply growth, and that's it, right? Like the population goes up. If the supply goes up as fast as population, prices stay the same. If supply goes up faster than population, then occupancy starts falling, and then prices go down. And that's how rents are set. It's how the value of the property itself is set in the end. So if you're above the long-term historical occupancy, you're on that upper end of the quadrants. You're either in expansion or hyper supply, because you have long-term historical occupancy, and I'm talking like 20-30 year historical occupancy. And then the second variable you look at is the direction occupancy is going. Is it going up or down? If it's going down, you're in hyper supply. If it's going up, you're in expansion. And if you're below the line, it's the same thing. If it's going down and you're below long-term occupancy, you're in recession, right? Occupancy is still falling. And at the same time, you're below long-term historical occupancy. And then when it starts coming back up, that's when you're in expansion, or you're back into recovery and moving towards expansion. So what we know right now is we're in hypersupply in most markets that I follow. Occupancy levels are going down slightly, right? Some markets it's still going up, which means we're still in expansion. So we're clearly not in a real estate recession right now. Now, that isn't to say we won't be in a real estate recession tomorrow or the next day, right? If occupancy suddenly drops dramatically, right? And there's only 2 ways that can happen. People leave. Maybe there's another pandemic and a bunch of people die off, and so now there's not as much demand, or they have to produce a lot more supply of multifamily housing or single family, whatever market segment you're tracking. So in that case, we know that COVID has actually dramatically slowed down the process of producing new units.
Yep.
And that's expanding the period of time where we stave off recession, because population did not go down dramatically. It went down. I mean, it stabilized actually. Birth rates have been falling for generations. Immigration tightened dramatically during COVID because people couldn't cross the border. And then you had a couple million people die of COVID, some of which would have died of other things, but some of which wouldn't have, right, during that time. So you have a slight pause in population growth. We went from an average of 3 or 4% a year in the US to pretty much flatlined for a couple of years. But you also have a huge pause in the new supply coming on the market during that time. And there's a huge lag in this. So I feel like I'm getting into lecture mode, so I apologize.
No. I love it. This is what fascinates me, is this part right here, because the supply is still so undersupplied that I'm curious to know how that can ever switch.
Yeah. So what's going on with the supply is it takes about 18 months to build a new apartment complex, right? I mean, 18 months to 2 years in a normal market. COVID, supply chain issues, material costs going up. But frankly, I went to order apartment windows for an apartment building, and we ordered them in May of last year, and we got them in January, right? Like used to we get them in 5 weeks, 6 weeks. This literally took 6 months to get 6-week windows. Well, if you're trying to do that, you're not adding new supply. And that's true for rehabs too, right? Like if you're rehabbing an old unit that's down and dead, if you can't get materials, you can't get it back on the market. Turns are taking longer. All that stuff is contributing to lower supply of residential real estate. And I mean, it's the same as true with single family stuff. They haven't built, for about a year, no one started building houses because they didn't know what was going to happen with COVID. And they were like, we have to wait it out and see what happens. Okay, well, so we have a huge pause in supply, and we were already sitting on about a 2 million housing unit shortage going into COVID. Now it's probably more like 4 or 5 million unit shortage. So the only way that changes, in my estimation, and causes occupancy to start falling again is, like I said, people either have to die off or leave. Maybe we'll have a mass exodus. Everyone will decide to do like Jeff and move to the Caribbean, because I love the Caribbean. In fact, I've been living in Puerto Rico half the time for the last year.
Nice.
Yeah, it's amazing, right? I mean, it's a great place to live. But most people aren't in the position to do that, right? So a lot of people are still going to live in Chattanooga, Tennessee, where I am right now. And those people are still going to need a place to live. And if they can't afford to buy a house because interest rates are going up, they have no choice but to rent a house or an apartment. If you're going to live here, you have to have a place to live. So you're either going to rent a house or what? I mean, there is one other choice, and this is what happened in 2008. The economy got really, really bad. Unemployment spiked. No one had jobs. No one had money. They couldn't afford rents. They couldn't afford house payments. They lost their houses. Occupancy started falling like crazy, really, really fast. And this is the big thing. Because they didn't have jobs, they couldn't afford rent. When there's inflation like we have now, but unemployment is still very, very low, like 3.6% is the last number. People have jobs, they reprioritize their spending. You don't go to the movies, you pay your rent. That's what you do when you have a job and you need a house, right? So when costs are going up, you just do less things, but you still pay your rent, you still buy food. Those are things you just don't have a choice on. And so unless we see unemployment going up dramatically, which could happen in a deep recession, then it's very unlikely that housing prices are going to crash in the next 12 months. Now, I can't predict, 3 years from now, 4 years from now. There's a lot of variables there. We still don't know exactly what's going to happen with COVID. We're getting to the end, I hope, right? But we don't know exactly.
Yeah.
I certainly didn't expect us to be still talking about it in a prospective way 2 years down the road.
No.
But here we are, right? So it is what it is. But as we sort of move forward on this stuff, demand will fall on especially like high-end single family houses, office buildings, probably some retail stuff because of the Amazon effect. But your things like storage units, lower end housing, workforce housing, apartments, even Class A apartments. The demand for that stuff is going to continue as long as the economy is still producing jobs. And right now it's producing jobs. they're doing a good job trying to scare us away from that. You know, they're trying to control inflation, which is really a sign of an overheated economy. That's the ironic part, right? Everyone's talking about recession, but inflation just means the economy's on fire, right?
Yeah.
Like there's so much demand and so much money out there that no one knows what to spend it on. So they're willing to pay more for the same goods. That's one sign of one of the net effects of
Fascinating
inflation.
perspective.
Yeah. So I mean, we're in a situation where they're trying to raise rates to shock the economy, to slow it down. That's really why raising rates slows inflation, because it causes people not to spend money on new development and new business and buy equipment and stuff because it costs more to finance it. That's one way to slow it down. The other way is to talk about how we're going to be in a recession and everything's terrible. And we're hearing that everywhere right now.
Everywhere.
They're telegraphing recession because they want to scare people into not spending money so inflation will get under control. Because honestly, the Fed can't afford to raise rates high enough to kill inflation right now. See, this is another thing that, and I don't want to get over conspiratorial on this, but
No,
classic economic theory is that the only way to slow spending is to raise the rate of borrowing above the rate of inflation. Right.
Yes.
Well, inflation is 9.1% right now.
So why not just hyper do it? Why not just be like, all right, we're raising rates to 12% right now.
Right. Which is what Paul Volcker did in the early 1980s. He just shocked the system by raising rates like crazy in a 1 or 2 year period. And that's what they should do if they want to control inflation. The problem is, who owes the most dollars in the world?
The US.
Yeah. So you raise rates, who has to pay the most interest in the world?
The US.
Yes. If you have to pay a lot of interest and you don't have a lot of money coming in, what do? You print more money. So we can't do it. Like if you raise rates right now, the only thing we can do by raising rates is print more money to pay the interest. Right. So like they painted themselves into this like ridiculous position where they really don't have control over inflation, which actually I'm a fan of in reality, because if they'd stop manipulating it, this stuff would fix itself. Like there's always been slight booms and busts, but they got a lot bigger when the Fed started messing with it, right? Because they try to push it out. Oh, we don't want a recession right now. We'll wait, we'll push it out till later. And then they create a bunch of stimulus money, which creates a huge amount of inflation. And then they're like, oh, we have to borrow some money to pay. I mean, it's just like a never ending cycle. And they just keep thinking they can outthink like basic economics, but like I'm skeptical about any one person's ability to outthink basic economics. I certainly can't. And I feel like I'm a pretty smart guy about this stuff. I read a lot of stuff about it and I kind of went, I wouldn't mess with it. I'd just let this stuff happen, right? Like if we went to a pure gold standard, once they went off the gold standard, I'm not a big gold bug or anything, but when they went off the gold standard and they started printing whatever they wanted, that's a real problem. When the gold standard was here, we had minor booms and busts. The exception was the Great Depression, but the Great Depression was coming out of a World War II hyperinflationary scenario where most of the world wasn't on a gold standard. We happened to be, right? But most of the world wasn't, right? And then all this money was flowing to us, and there was a ton of speculation and mass hysteria, which is, ironic, because that's really what happened in 2008 with housing too, is there's a bunch of speculation, which we are not seeing now. So another reason why I don't think we'll see a huge crash. But that stuff, with the exception of that one little blip, which would have been fine had not been for categorically bad famine right at the beginning of the Depression, right? Like we had the 3 driest years of drought at a time when we didn't have good agriculture. And so we had a huge amount of famine. It's really the only time where people couldn't buy food in the US in our entire history. Happens other places, but it happened here too, And, so you had the Dust Bowl thing, you had all these farmers, and then they had really bad economic policies because they tried to fix it by stimulating. So they temporarily took us off the gold standard and it got worse, not better. I mean, it's like history, people, just like let's just stick with what we know works, which is that and this isn't even the first time, during the Revolutionary War, they did the same thing, right? They were using gold standard coins, like coins that were backed by real assets. And then they decided, we got to print a bunch of stuff. And then they came up with these things like, it's not even worth a colonial, right? Like it literally is because it was made up money, right? Like they made up money and no one wanted it. Like, and they started out paid at 1 colonial a week, and then it was 1 a day, then it was 10 a day. And pretty soon, everything was 100 times as much. You know how they fixed it? They just trashed the currency and went back to gold.
Wow.
So maybe what we need to do is just start trading in silver, and this is actually where the cryptocurrency stuff comes in, right? Like they're trying to fix it with like a modern version of gold. There's a lot of problems with that market because there's a lot of, unresolved technological issues that people aren't really paying attention to.
Yeah. But it's not enough attention.
I'm sympathetic to it, right? It makes sense to me.
Yeah. You had this like couple that's still like $4 billion worth of Bitcoin. And they're like average Joe, like not to take away. I mean, they did something, not to say they're not intelligent, but right. By no means are they like the most intelligent. And
they're not super villains, right? They're not
and they were able to take like $4 billion worth of Bitcoin. So it's like, forgive me if I'm not gung ho about replacing,
Yeah, well, and that's the thing, right? So the problem with the Bitcoin is it's completely deregulated, right? So this is regulated by the crowd, which means that there's no one there to like insure against fraud, right?
Right.
Like if I go to the bank and I figure out a way to steal $4 billion from my local bank, you know what happens then? I'm probably going to prison. One, yes. Right? But two, the bank's insured by the government because the government guarantees the money, right? like you don't lose your money if it's in the bank and someone steals the bank's money, right? Like Correct. The government pays you still. I mean, it's not awesome, but it's a mechanism there that creates faith and credit in the ability to utilize that. And that doesn't exist in a deregulated system right now. Now, they may resolve that. It's just too early to know for sure. I'm not saying people shouldn't have 1-2% of their assets in cryptocurrencies, or maybe 5 or 10 if they're really they're willing to take a lot of risk. But I mean, I live in Puerto Rico, like the cryptocurrency hub.
Oh yeah, that's a huge wave down there.
Everyone's crypto. They have crypto meetups every week. I mean, I think there's about 3 crypto meetups a week in San Juan where I live, and I go to these things and I meet these guys are super smart, these guys and ladies, and I meet them and they're doing all these really cool things and they're talking about stuff that doesn't even make sense to me. And I'm trying to pay attention, and learn from it because I love, learning this stuff. But I still come down to, I don't understand it well enough. And one of my core investment philosophies that's always served me well, and whenever I've disregarded, I've gotten burned, is only invest in things I know.
Yeah, crazy. What an outlandish investment theory.
So I don't buy whole life insurance policies or get into the infinite banking stuff. It might be amazing, right? But I don't understand it. I don't have the time to figure it out. So I just don't do it.
You know what? Shout out to MC Laubscher, and I've had Drew White on as well, if you know him. Incredible guests. Just when I thought I knew it, all of a sudden they just get more in depth, and I'm like, and I'm lost again.
See, and those guys, they should be doing it. And frankly, maybe we all should. I'm not criticizing a particular,
correct,
a particular thing. I feel the same way about, NFTs. They might be amazing, or digital real estate or something. It could be the next thing, and I might be missing out on a gold mine. But I'd rather miss out on a gold mine than waste a bunch of resources on something that's garbage. And since I can't tell the difference right now, because I don't have the energy to put into it, I keep learning. And
I'm still trying to learn the ins and outs of real estate. And listen, you never become an expert, right? You're always going to learn every day, but you can get to a point where you have a pretty good grasp on it. And then that's when you can start diversifying. But too many people want to know when it comes to investing, and this is purely subjective. I'm not obviously licensed to give advice or anything, but when it comes to stuff like this, you really should learn one thing first. If you try to learn a little bit about everything, you'll never really understand. And I feel like that's where you lose.
Yeah, no. And that's, I mean, listen, I do different stuff now than I did when I first started, but if I didn't buy that first $30,000 condo, I would not be where I am now. Right. So there is something to be said about just doing something and learning as you go, because that's a lot of what I did. But I'm really, when I think about risk and return now, I think about the fact that there's a discount rate, like a rate of return. That's the risk-free rate of return, which right now, because they've raised rates a little bit, is maybe a couple percent, right? Like anything above a couple percent is risk premium, and you're getting paid for taking risk. And, the more risky something is, the more return you should get on average, right? But for me, I don't really like risk that much. Like, I'm fairly risk adverse. but I have to take risk if I want to get more than 0% for the last few years. And so I take risk. And what I look for is an opportunity to get something I call asymmetrical risk and return, which is where my personal risk is less than market risk. Because, if you buy a duplex on a street that I own 10 duplexes on, right? Like just as an example, I know that street better than you. You're taking more risk than me if I buy that same duplex, even if I buy that same duplex for the same price, because I have better synergies and stuff like that. Right. So for me, I want to get hyper local on my asset class, hyper local on my markets. And I want to really dig into that market, and I want to really learn a lot about it, because one way to mitigate risk is to have better knowledge. If you have better knowledge, you have less risk. But the thing is, the market doesn't pay me for my risk. It pays for market risk.
Yep.
And so if I can get 10% returns, but really, I'm getting the 2%, risk-free rate of return plus an 8% risk premium, but my actual risk is maybe only 4% of that, then I'm basically getting super ordinary returns with less risk.
Yep.
And I love that. And that's what I try to do in all of my investing. So that's why I said at the beginning, and this, even outside of real estate, I only invest in what I know, right? Because if I only invest in what I know, if I understand something really well, I'm taking less risk than if I don't understand it. And whenever I disregard that, somebody says, oh, you should buy this cryptocurrency or whatever. Sometimes I've done that, like just like on a whim, like, oh, I'll put a few $100 in that. And a couple of times it's worked out really well. Like when I bought 10 Ethereum for $12 a piece, that one worked out really well.
Yeah, I bet you wish you would have put 10 grand into that.
Yeah, I certainly do. But you know what? Other times I bought stuff for a couple $100 in crypto, and it's worth like 4 cents right now,
Yeah.
And so like if I put 10 grand into one of those and it was worth like 40 cents, I'd be kind of pissed, right?
Yep.
But I don't understand that, right? So that's like gambling in a lot of ways. And
it's full of gambling. Yeah. That's what nobody's.
I'm okay with gambling. I like gambling. I go to the casino and play blackjack once in a while, but I know what I'm doing when I do it. And even there, notice I play blackjack at the casino because I understand the game and I can mitigate my personal risk by playing it correctly.
Correct.
Like if I went and played craps, I would do terrible because I wouldn't have a clue what I was doing.
Yeah, crypto is just unregulated gambling right now, is exactly what it is. And you can't mitigate for anything because you don't know what's going to happen. You're truly, it's not producing anything, which means you're truly just hoping that when you buy it, somebody else wants to pay more for it later.
Yeah, I mean, in a way, that's, in a way, there's always a little bit of that in anything you invest in, right? But it's easier to predict the future demand on stuff that's predictable, like
Correct.
Real estate, like what we were talking about at the beginning of the show, right? We can look at demand. We know people need to live somewhere.
Yep, totally.
So if I know someone needs to live somewhere, or I know they need to store themselves somewhere, or I know then they need to go to the grocery store, I can look at that and say, I can buy that grocery store building because people need to buy food. So people are going to show up and buy food. Yep,
absolutely. What opportunities are you most kind of paying attention to, do you think will present themselves here over the next little bit?
Yeah, I mean, so we talked about
real
this
estate
a little bit off the air as well, but I do think there could be some opportunity to pick up things that people have bought, not anticipating rate increases. So I know a lot of the syndicators, a lot of the real estate, people that are buying apartment buildings, 100, 200 unit buildings. I know a lot of these guys personally, most of them are pretty good, but I know, 20, 30% of them that I think are just like, they've benefited from an up market so long. They think they're good, but they're not actually that good at what they're doing. And like, I mean, I know one person that, has sold a couple of buildings without doing anything and made good returns. They held it for a year and then sold it and made a huge return for their investors. Great for your investors. But it also creates a track record that's false.
Yes.
And they, if you bought a year ago on a bridge loan, thinking that you're going to refinance to a 3.5% Fannie or Freddie loan, and when you ran your numbers on underwriting, 3.5% meant you were going to make a reasonably okay return. Well, if you're refinancing to 5.5%, you might be losing money every month. Like you might not actually be able to even do it because it might not meet a debt coverage ratio or something. And I think there's going to be assets that aren't even distressed that are unsalvageable for the current operators.
Yeah.
And they're going to either have to go raise more capital, which, maybe if you had a good track record and your investors like you can go out and say, hey guys, we didn't anticipate these rate increases, are bad. The deal's still good long-term. There's nothing wrong with it, but we need to raise more capital because we cannot finance enough to pay off the current loan and do a capital call. That's hard to do, but that's what they should do. But most of them won't do that. They'll just assume that they'll figure it out. And those people that assume they'll figure it out will end up in, panic sale situations. And some of those will come to the market at a slight discount to market. The market's still fundamentally strong. So I don't, again, for the reasons we talked about before, I don't see huge discounts, but that will start to put downward pressure on the market. And if rates continue to go up at a slowish rate like they have been, then that pressure will continue to mount, and eventually the market will cool off. I mean, we're not immune to it, right? Like there will, as long as rents are going up, and they are going up right now in almost all markets, right? As long as rents are going up, people have an incentive to build more supply. When rents start going down, that's when they stop building new supply. I mean, it's literally that simple. As soon as rents go down, people stop building supply. And the problem, of course, with that is if you go back to that hyper supply segment of the quadrants, in hyper supply, rents are still going up, even though occupancy is falling, because you're above long-term historical occupancy. And so people are like, oh, my building's almost full. Like if you're at 99%, you raise rents. But if you're at 97%, you raise rents, right? It's like 94%, you go, oh, I better not raise rents because I've got 6% vacancy. Well, if you underwrote it at 4% vacancy and you're at 2, and you go to 2.5, we're in hyper supply, right? The market's starting to loosen up a little bit, but rents are still going up at that point. And because rents are still going up, people will still start new construction projects, and they're going to take 18 months to 2 years to complete. So then you're going to be in this situation where rents are falling and new supply is still coming on the market. That's what a recession is in real estate.
And that's where you see the real estate finally catching up and actually correcting. And you said like a couple more years though.
Yeah. I think 2024, 25 is most likely the peak. And then we'll see falling prices 26 or 27. Those 2 years might be bad years to own real estate. I mean, not really though, because the real truth is it's super easy to time the real estate market. I tell people this all the time, and people don't always pay attention to it, but it is literally this easy. And I made a little rhyme up to remember this. Buy whenever you buy, right? So just buy whenever you buy, only sell when it's high. That's the whole thing, right? Buy whenever you buy, sell when it's high. Like, because if you bought in 2006, right? And then the market crashed 40% the next week, and then you had to sell in 2008 or 9 because you had to refinance because you had a bridge loan, or you had a balloon payment or something, you're in trouble, right?
Yep.
But if you bought cash flowing assets in 2006 and you didn't have to refinance or sell in 2009, 10, 11, 12, you're fine. Sell now. You're super happy. You're way, way, way ahead of the game. So if I'm buying real estate right now, and I'm putting long-term debt in place, non-callable long-term debt, making sure I have good cash flows, because cash flow is that's your metric of safety. I look at cash flow as insurance, right? The more insurance you have, the better, right? Because cash flows go down, they go up, but if you have enough cash flow, you're never going to lose the building. Because if you have non-callable debt and you pay your mortgage payment, you keep the building forever, right? So, and if you wait long enough, even if it went down, say you bought a house for 200,000, it went down to 150,000 the next day, and 30 years from now, it's only worth 150,000. So what? You still made money. You're like, oh, I lost 50,000. No, you didn't lose 50,000 because you probably put like 40,000 down on the place. And now your 40,000 is worth 150,000 because over 30 years, someone else paid the mortgage off for you. Right. So
exactly.
To me, it's like super forgiving over the long term. So buy whenever you buy, wait and sell when it's high. So if you have some stuff right now that you've had for a while, maybe take some money off the table. It makes sense to me. The market might soften.
Yep.
Good. And my theory that it's 2-3 years out is controversial. And I'm not a genius. And I told you at the beginning, I believe it's a fool's game to try to predict the market or manipulate the market. This is my speculative position. I'm taking defensive positions right now because the market's super high relative to where it was a couple of years ago. So I'm increasing cash flows, increasing cash reserves, and selling off properties that I don't think are as good as other ones. And then buying
exactly, and lowering your LTV too. You don't want to be over leveraged.
Yeah, I'm not re-levering stuff up, I mean, some a little, right? Like if I have a property that, we bought it with 20% down and now it's at 50% loan to value, I'm going to raise it to 70. I'm not going back to 80, you
Right.
know? I mean, I'm not saying I won't pull cash out, because pulling cash out is another, there's value to having cash too, right?
Totally.
One thing I learned from, well, geez, I hate even mentioning the guy's name, but one thing I learned from Trump way back in the day, way before he was president, when I was reading his books about real estate, was that it never hurts to have cash in a recession. Like if you have cash, you have cash in a recession,
opportunities.
There's opportunity everywhere, and you can't borrow cash in a recession because the banks just go like that.
Yep.
Tighten up like crazy. So
yeah, couldn't agree more.
Getting some cash out, cash out refis right now, as long as you still have healthy equity and you have good cash flow, makes some sense. And then if you have properties that are a pain, selling them, sometimes the property that's a pain for me might be great for you, or vice versa.
Totally.
Like that street of
and that's
yeah. Well, it's like that street of duplexes, right? Like if you have that one duplex on my street, might be a terrible deal for you to keep it, but it might be great for me. So you just, reposition, buy something that's easier for you to manage, whatever it is.
You're going to see, and like my primary focus is self-storage, but you're going to see, mom and pop owners who see this coming. They're like, I don't want to go through another one of these, boom, I'm out. Or, maybe they have 3 or 4 locations. And like you said, there's that one that just really, they just don't really want to put in any of the CapEx. The deferred maintenance is just built up, and there's a group that can come in and is more than happy to take that on. You know what I mean? So
and also too, like you're going to see people that have balloon payments or refi situations, or they're looking at inflation and being like, oh, it's just so expensive to hire people now. And, cleaning is more expensive and supplies and maintenance are more expensive. I just don't want to deal with it anymore. And you get tired people too. People just sort of like, I've been doing this for 20 years. I'm done.
Yep.
And the market's high right now, so I might as well cash out.
1,000%.
And I mean, I think there's wisdom in that. If you've been in real estate for 30, 40 years right now, and you've got some property that's, you're having to deal with it regularly, maybe you should sell it and go hang out on the beach with me in Puerto Rico.
I couldn't agree more. I mean, that's really what I'm setting myself up for, is take advantage of these opportunities so that, learn now, right? Like, as much as I wish I got in 2 years ago and enjoyed some of this kind of trip and fall and 2x your deals.
You should have got in about 10 years ago.
Yeah, I know. But now really learn how to actually do this. So then when that time period comes back, then it's like, oh, cool. Now I can go hang on the beach.
Yeah, no, and that's the thing, right? Like, so I'm extraordinarily lucky. I mean, I have a really good life. I went from bankrupt to retired in 7 years. But the only reason I was able to do that, one, take a lot of action and really stay focused, get creative, all that. I mean, I'm not minimizing that, because a lot of people in the same situation didn't do what I did. But I also benefited from like the best real estate market. Like I started buying in 2011. About the exact bottom of the market, right?
Yeah.
And stuff that we were buying back then, like we were buying houses in Detroit is where we started doing this, and we'd buy these houses for
10,
like
20 grand,
five grand, and they'd rent for like 600 a month. I mean, it was like, people are going, you got to go for the 2% rule on rents, and we're like, we go for the 20% rule on rents. Like now, if you got a 0.5%, people are happy about it, right?
Yeah. Yeah. And by the way, now those pieces of properties have 10x in your.
Yeah. Well, and I sold properties for $20,000-$30,000. I thought, this is amazing. I remember we bought this one house at a tax sale in 2013 for $650. No lie, $650. And walked to the front door, knocked on the door. There was someone living there. This lady's about 95 years old, right? And she says, I don't understand how you can own my house. I've lived here for like 10 years, and I always pay my rent on time, right? And but she's paying the rent. Her landlord didn't pay the taxes. I mean, that's terrible, right? And I said to her, well, what's your rent? And she's like, $650. And I was like, okay, cool, you can stay. Let's just sign a new lease at $650. Didn't even walk in the house. Never been in the house. Paid $650 for the house, and we had a $650 a month rent.
Jeez.
Right? Sold it 2 years later for $19,000 without ever setting foot in the house. And the reason we sold it was we assumed there was problems with the house, but the lady never complained. We never went in. She didn't want us in the house, right? She just never wanted anyone in the house. And I was like, she's like 98 years old now. Like, I don't want to deal with this.
Yeah.
Right. But I look at that now and I go, man, should have kept that house. It's worth 120, 130 now, you know? But you know, we did like, well, we had one house that we were going to flip, and we got distracted and forgot about it for a while. And then we got a tax bill and we're like, oh crap, forgot we had that house. I mean, I know that sounds ridiculous, but you know, when you buy houses for $5,000, you buy 10 of them in a month or something. And then, you know, you just kind of fell through the cracks. And then when we got there, and it was like worse than we thought. And like, there was like issues with the neighborhood and stuff. And we're like, we'll deal with this later. And then forgot about it again for another year, literally set vacant for 2 years. Right. And then just last, like literally like this morning, like today, my partner calls me and he goes, hey, I'm going to send you a video of the house. Like, we just got done renovating it. We bought it for like $10,000, like 5 years ago now. We did nothing until like a month ago on it. And we're going to sell it for $170,000.
That's insane.
Yeah. I mean, we put 30 in, I mean, but still you make $120,000-$30,000 just letting it sit there for 5 years. I mean, that's dumb. Like this is why so many people made so much money, and why you can't trust records of people that are just out there. You shouldn't even trust mine, really, because like, look how terrible that was, right? No.
You just always hear such horror stories from like '08, especially. And the thing that nobody's paying attention to is how many people just got, like, you watch Robert Kiyosaki interviews. He's like, I like quadrupled my net worth because of '08.
Yeah. Well, I for sure did. And
Yeah.
I mean, way more than that. I mean, well, '08 was a particularly hard year because that's when I got leukemia. But you know, so I didn't really quadruple. I went from about an even net worth with student loans and stuff to literally a negative net worth because I got rid of all my debt, but my student loans stayed, right? So I had no assets. I owed $100,000 to the feds, right, for student loans. And then I quit practicing law. So I was paying on student loan, in fact, still paying on them because they're cheap. But yeah, so paying off student loans for something that I haven't done in more than a decade, right?
Jeez, that's
but
crazy.
the flip side to that is I don't regret any of it, because if I hadn't gotten sick when I did, I wouldn't have, I wouldn't have gotten into real estate when I did. So, I mean, I was very fortunate. Like, if I'd got leukemia 5 years later, I would be much poorer today. If I'd gotten it 3 years earlier, I would have been much poorer today. Like, the timing was amazing.
I love that perspective so much.
Yeah, I mean, and we can't regret this stuff. Like, we make our decisions. You know, some of that was my fault. I mean, it wasn't my fault I got leukemia, obviously, but like, it was my fault that I had set myself up in a situation where I had a $5,000 a week to break even nut at my office and didn't have a plan to what happened if I couldn't work, right? You know, that lesson learned there. I don't want to do that again.
Yeah.
That's one of the reasons why I'm highly motivated to be in real estate. And also, by the way, why I've never been the super hands-on operator in real estate. You know, I've always partnered with people that could do everything that I'm doing. You know, because that way, if something happens to me, like, I thought I might get the leukemia might kill me, and I wanted my wife to not have to worry about things. And
Totally.
so I've always set myself up to have this ability to walk away, which is amazing, because then when I had enough income from real estate to walk away, it didn't really change anything.
Yeah.
Because I was already set up to walk away. That's why, like, I tell people all the time, you know, I've managed a few of my properties here and there personally, but like, do that to learn. Don't do it because you want to make the extra money for the 7, 8, 9%, whatever it is, because
Totally.
you're going to want to walk away at some point. The whole secret to life, not just to real estate investing, but life, is figuring out how to buy back your time as soon as possible. And my life is extraordinarily better because I don't have to be involved day to day in my real estate.
I can only imagine. I love that so much. Definitely the direction I'm heading. So as we wind down here, we'll jump to the final 5. I got 5 questions asked all the guests. Best advice you've gotten from a mentor?
From a mentor. Oh, that's a good question. All right. So I'm going to cheat a little bit and pick somebody who's like, not a mentor, but kind of a mentor. Richard Branson. And he doesn't know who I am, but I know who he is. So that counts, right?
Yes.
But I was literally like, when we were first deciding whether we wanted to get into multifamily or not, I was reading his book, Screw It, Let's Do It. And we were right on the line on whether or not to do something. And I just went, and I read this quote. It said something like, the difference between successful people and people who never succeed is that successful people take action without all the possible information.
Yep.
And I went, oh, well, time to go. Let's go do it. Screw it. Let's do it. So
1000%. That's why I'll put someone who's done one deal up against someone who's been reading books for 5 years, but has never done a deal. Right. Like,
yeah, great. You have tons of knowledge. You've listened to every episode of 700 podcasts.
right.
Cool. But that doesn't, like, and I'm not discouraging people. People listening right now, keep listening to podcasts, keep learning. I listen to podcasts, I read books, I do all that stuff. But I also, you got to take action.
Absolutely.
Don't wait, just take action.
Absolutely. What is it about your career that makes you feel like you're fulfilling your why?
So my passion is really helping people live the best version of their lives. So I have a podcast called Last Life Ever, where we just do that. We interview people doing exciting and interesting things. And I come on other people's shows and I talk about, things like what we didn't get into, how to give up bad days, which is really easy. Just don't have them because they suck. Choose happiness over bad. It's not that hard. But that's the thing for me. It's like, I have the freedom now to spend time focusing on the things that I think are important, and the things that I think are important are helping other people have the freedom to spend time on what they're thinking is important, which I realize is sort of circular, but it really is. It's the thing that matters most to me.
Yeah. I love that so much. Favorite non-real estate or investment related book?
Travels by Michael Crichton.
Ooh, okay. I'll put that on the list.
Yeah. So Michael Crichton is the author of Jurassic Park. And he also was the creator of ER, the television show, and Westworld, the HBO show.
Yep.
It's based on a movie that he directed. But he's the only guy ever to have the #1 best-selling book, the #1 best-selling movie, and the #1 rated television show at the same time, which was when he had ER. Jurassic Park was the first one, was in the movie theaters. And then his book, Congo, was the #1 best-selling fiction book the same day.
And then that became a movie too.
Yeah. Of course, they've made tons of movies on his books. Unfortunately, he died a few years ago and I didn't get a chance to meet him, but Travels is his autobiography.
Okay.
It's fascinating. It's inspired me to do a lot of things I never would have done otherwise. That's a guy who lived a really extraordinary life. And I actually, in a lot of ways, try to model my not all of my life after him, but I try to model myself after people that do really interesting, exciting things. And so that's why I do things like go sailing across the Caribbean when I never did it before and run out of fuel in the middle of the ocean. But why not? Right. And that's why I'm going to Tanzania next week. So
Sweet.
Could be worse. Yeah.
That's awesome. We're definitely going to have to catch back up in like 6 months or a year or so and see where we're both at. If you could have any superpower, what would it be?
Infinite life.
Nice.
Yeah. I don't know. No one's ever asked me that, but
nobody's ever given that answer. I love that.
My goal, if I have a specific life goal, if I could have one, would be to live to the energy death of the universe.
That would be sweet.
I just like to stick around and see how it all wraps up.
Honestly. Best way for people to get a hold of you and learn more.
The Last Life Ever private group on Facebook is good, but I mean, honestly, the best way to get a hold of me is probably Instagram. It's just at Jeffrey Holst, JEFFREYHOLST, or my website, jeffreyholst.com, or really just Google me and you'll find me because I'm not hiding. I use my name everywhere. I've been on a couple other podcasts. I also have a book coming out, No Bad Days.
Nice.
No Bad Days, How to Make Every Day Great.
I love it. I can't wait. Jeff, thank you so much. This has been absolutely incredible. So much amazing insight. I appreciate your time.
Yeah, thanks for having me on. I enjoyed it.
Absolutely. Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to CataniCapitalGroup.com to learn more.